Dear viewers and the students, hopefully all of you are doing very well. Today our topic is dividends and the dividend policy, and I am Dr. Sarod Khandaker, who will give the lecture today. Now before going to the lecture, let's talk about the chapter objectives. The following are the chapter objectives. Number one is know the different forms of the dividends and the appropriate dividend payment terminology. Second, outline the arguments supporting the case of dividend is irrelevant. Third, discuss factors favoring a low or high payout. 4. Explain the residual dividend policy. 5. Illustrate the situation of share repurchases versus paying cash dividend. 6. Understood both bonus issues and share splits. And at the end, we'll also outline the various employee shares ownership plans. So let's start. So the types of dividend. So as we know, a dividend is a payment made out of a firm's earning to its own shareholders or the owners of the corporation. Now dividend can pay regularly by a corporation. So dividends generally are paid in form of cash, and the types of dividend includes from the corporation, which can be the regular cash dividend, extra dividend, special dividends, and the liquidating dividends. In the next slide, we'll discuss each of them. First is the cash dividend. Public company commonly pay regular cash dividends twice a year, and interim dividend and also the final dividend. So generally, you can find that the cash dividend are paid twice a year, generally 1st of January or the 1st of July. So this is basically the interim dividend paid by the corporation. Now remember that after a dividend is declared, it's distributed to all shareholders at a form of specific date. The amount of the cash dividend is expressed in terms of the dollar per share, and dividends are also expressed as a percentage of the market price. Now this should be noted also that after the dividend has been paid by the corporation, generally the share price of the corporation declined as a percentage of the dividend payment. Now in this slide, we talk about the procedure of dividend payment. Let's take an example. Here is the declaration date, which is say Thursday, January 15th. Wednesday, January 28th is the ex-dividend date. Friday, January 30th is the record date. And Monday, February 16th is the payment date. If you look at in here, from the declaration date to the ex-dividend date, there are about 2 weeks gaps or the difference. From the ex-dividend date to the record date, there are 2 days gap, and then there are about another 2 weeks gap of the payment date. Now how it happens, and what are the definition of each of these payment dates. So the declaration date is when the board of the director declares a dividend payment. Ex-dividend date, if you buy the share on or after this date, the seller is entitled to keep the dividend under the ASX rule or the Australian Stock Exchange rule. Shares are traded ex-dividend on or after the 7th business day before the record date. So which is the record date? So the record date is when the dividend are distributed to the shareholders of record on a specific date, and the payment date is the dividend check are mailed to shareholders for the record. So one of the most important things is here that under the ASX rule, shares are traded ex-dividend on and after the 7th business day before the record date. So if you go back, the record date is 30th of January, so 7 business days before, it will be the ex-dividend date, or it will be traded as an ex-dividend. So what is an ex-dividend? When shares are traded in the stock exchange, but it does not include the dividend. So the seller of the share will keep the dividend for himself. But if before the ex-dividend date is set in the market, then the buyers of the share are entitled to keep the dividend. In this slide, I'll show you about how it really happens in the market. Now this slide shows you about the ex-dividend, the price talk, and the reaction of the market. Let's assume we're talking about a share of ABC Corporation. The price of the share is $10, and the company declared to pay a dividend of $1. So the share price will fall by the amount of the dividend on the X date, which is time T. So X date is the time T here. If the dividend is paid $1, the price will equal to 10 minus 1 is $9 of the X date. So the share price was initially $10, so it was trading in the market $10. After the ex-dividend date, because the buyers because the seller is entitled to keep the dividend, so the share price drop. So as per the example, the dividend is $1. So from $10, which was the original share price, and $1 is dividend, so the share price dropped to $9. 10 minus 1 is $9. So the share after the X date, the share price dropped to $9. So before the X date, say minus 1, which is in here, the share price was $10, and dividend paid is 0. On the X date, which is time 0 here, dividend paid $1, and the price of the share dropped to $9. Hopefully you understand this part. So, do dividend policy matter? So, for answering this question, we can look in both the side. Yes, the value of the share is based on the present value of expected future dividend, and the dividend are paid in cash, and everyone likes cash. So if you look at these two factors, yes, dividend policy do matters. On the other hand, the value of share is not affected by a switching of the dividend policy, as you can see, because, for example, the share price was $10. After paying the dividend, it becomes $9. But if you add 9 plus 1, it's still the 10. So the value of the share is not affected by switching a dividend policy. So in that case, it does not really matter. So should the firm pay out cash now or invest the cash or pay it later? So is it a good thing for the corporation? So the question is here that should the firm pay out cash now or invest the cash and pay out it later? So which is good for the corporation? Is it paying the cash now as a dividend? And we know that as the dividend will be paid on the share, then the share price will drop. Or should the company invest the money so they retain the earning and pay out later? So let's look at some examples. So does dividend policy matter, for example? So in this illustration, it is showing that the company's original dividend policy was year 1, $1,000, and year 2, $1,000. Okay, and R, or the rate of return in the market is say 0.2 or 20%. So if you calculate the price of the share, which is PO, is $1,000, $527.78. Because in year 1, it will pay dividend of $1,000, and year 2, it will pay dividend of $1,000 as well. But as we know, the price of the share is the present value of all future dividend entitlement. So in this case, the price of the share will be 1527.78. However, now assume an additional $200 of the dividend is offered, financed by an issue of debt or shares. Now, so the new dividend plan will be, as it's planning to give a $200 ex dividend year 1. So initially the dividend payment plan was $1,000 plus $200. So year 1 it will be $1,200. However, for year 2 it will be 1,000 minus 250, so minus 240, which is $706. Now, why there is a minus 240? As I mentioned before, that any future dividend increase will deduct in some other period of time. So as the company is actually increasing the dividend payment of $200 in this particular part, and it should be financed by either issue of the debt or the shares. So in future, some point of time, they need to return the money, and that is exactly the $240, because $200 in 2 years' time at market rate 20%, it would be $240. So this particular share will receive $1,200 dividend in year 1 and $760 dividend in year 2. So if you add this value, you will find the share price is 1527.78, which is equivalent to the previous policy, which is 1527.78. So it does not really matter in this case. So what did we learn from here? One is any increase in dividend at one point is offset exactly by decrease in somewhere else. As we need to remember that there is a concept of time value of money. So as in year 1, you borrowed $200, but year 2, they need to pay back $240. An alternative explanation is the homemade dividend. Individual investor can undo corporate dividend policy by reinvesting dividend or selling the shares. So that's another big policy matters. Third, company may help with creating homemade dividend by offering the shareholders automatic dividend reinvestment scheme. And in Australia, this is a very common scenario where the companies are offering dividend reinvestment scheme. So in that case, dividend policy does not matter. However, we need to also remember that we ignore a few real world situations or the factors such as the taxes. Now, in Australia, there is a dividend imputation system. Now, the dividend imputation system is removing the double taxation policy, which we can see some other countries of the world. Now, dividend imputation system results in shareholders receiving a tax credit with the dividend for the tax actually paid by the company. As we know, in Australia, currently in 2019, the corporate tax rate is 30%, whereas the individual tax rate could be, it varies from 30% to 48%. So the imputation credit can be offset against income tax on the income of the shareholders. So a marginal tax rate for individual shareholder could be variable, so it can offset some of the taxes. And the franking dividend are dividend that are paid out of company profits on which the tax has been laid. Now in this slide is showing the dividend imputation credit in Australia. For example, the marginal tax rate of individual is 15%, 13%, 40%, and 45%. And this is the shareholder's income. So $6,001 to $25,000 is 15%, $25,000 to $75,000 is 30%, $75,000 to $150,000 is 40%, and $150,000 plus is 45%. Corporate tax rate is 30%, which is the flat rate. The company paid the dividend, $70. Tax per additional assessable income is $100 here in all four scenarios. Tax on assessable income is 15, 30, 40, and 45. Now these are the individual cases. Credit from the company tax, as the company paid 30% tax, so it's already been paid 30% or the $30. Net credit payment is here is 15, here is nil, here is -10, here is -15. So what does it mean? It means that the tax to be paid on the dividend for this scenario, it should be -15 because the marginal tax rate of the individual is 15%, but the company tax paid is 30%. So this particular shareholder can claim the 15% of the $15 money back from the tax office. In this scenario, the corporate tax rate is 30% and the individual marginal tax rate is also 30%. So tax to be paid on the dividend is nil. The next scenario is marginal tax rate for the individual is 40%, whereas the company tax rate is 30%. So tax to be paid is $10. And the next example, tax to be paid is $15. So the dividend and the real world situation. A low payout is better if, for example, the optimal dividend policy is determined the various shareholder situation. Some shareholders prefer high franking dividend, others prefer the company to pay no dividend or retain the fund for the investment. So for them, the low payout is better because they don't really care. And also we need to understand the flotation cost. So high dividend payout may require a new shares issue, which could be expensive and decrease the value of the firm. So the flotation could be higher for this scenario. So this particular shareholders will prefer low payout ratio. The debt contractors sometimes may put a restriction on how much the dividend can be paid. So for that particular company which has high debt and equity ratio, they might prefer lower dividend payout. However, the higher dividend payout is better if we consider the following situation. So number one is desire for the current level of income. So the particular investors, so there are some particular investors that would prefer to have higher current income. Uncertainty resolution. So the bird in hand theory is important in here. So some investors would prefer to receive the cash in their hand, so they feel much comfortable and confident. And for some investors who do receive favorable tax treatment from holding the high dividend, they will also prefer to receive the dividend. So the resolution of the real world factors. So we can recall that based on the homemade dividend argument, dividend policy is irrelevant. 2. Because of the high taxation of some individual investors, a high dividend payout is better for some shareholders. And 3rd, because of the new issue cost, a low dividend policy is better for some shareholders. However, you also need to remember that when the company is paying the dividend, there are some information content on the dividends. So a dividend can increase of a corporation when the management believes that it can be sustainable or can be sustained for a long time. Second, the expectation of higher future dividends increase the present value of the firm. And the third is it also signals of a healthy and a growing firm. However, the dividend may decrease of the corporation because of the several factors, and it also gives some information to the shareholders if the dividend decrease. Number one could be the management believe it can no longer sustain the current level of dividend, so the company might like to reduce the dividend. Expectation of the lower dividend indefinitely decrease the present value of the company's shares. As we know, the share price includes all the future dividend entitlement. So any future dividend entitlement reduction, it will also reduce the value of the share, and it will also signal of a firm that is having some financial difficulties. Now, there are some clinical impact of the dividend policy. Now, remember that the share attract particular groups based on the dividend yield and the resulting tax effect. So some particular group always prefer, either the higher dividend payout or the lower dividend payout. Some investors prefer low dividend payout and will buy shares in those companies that offer low dividend payout, and some investor will do the vice versa. This slide will talk about residual dividend policy. First of all, we need to remember that the issue costs eliminate any indifference between financing by internal capital and the new shares, and the dividend are only paid if the profit are not completely used for the investment purpose. So for example, if the company have sufficient investment strategy or investment plan, it will only pay the dividend if it use all of if it cannot use all of the money for the investment, and any excess amount it will pay as a dividend. And sometimes the company would like to maintain its debt and equity ratio. So let's look to an example. Each row in the table below represent a different level of investment, and the firm desired debt and equity ratio is 50 or 0.50. So which means that 1/3 debt and 2/3 of the equity. So if you look at in here, row 1 is showing that the after-tax earning is $1,000. The new investment opportunity for this firm is $3,000. Additional debt is $1,000. Return earning is $1,000. Additional share is $1,000, and the dividend will be paying $0. Because the company is having a new investment plan or investment strategy, which they need $3,000. So this $3,000 will be funded $1,000 from the debt, $1,000 from the retained earning. They already have $1,000 after tax earning, and they will issue additional share of $1,000, and the dividend will pay $0. Second is after tax earning is remain the same. So remember the after tax earning is remain all the same here. The new investment opportunity is $2,000. Now remember they want to maintain debt and equity ratio is 0.5. To maintain a debt and equity ratio 0.5, they need $1,333 equity and $667 debt. So receive $1,333 equity, they're going to take $1,000 return earning, and they're going to issue $333 additional shares in the market, and they will also include, or they will also issue additional debt of $667. So this will make sure that the debt and equity ratio is 0.5. In the third option, their after tax earnings $1,000. The net investment opportunity is $1,500, as we are going to maintain a debt and equity ratio is 0.5. So the company will retain the earnings $1,000. They're not going to issue any new shares, but they're going to issue the new debt of $500. And the dividend opportunity is 0. Fourth line, the new investment opportunity is 1,000. Company is going to retain earning 667 because, as you know, the company is going to maintain a debt and equity ratio of 0.5. To maintain a debt and equity ratio of 0.5, they're going to pay the dividend of $333. At the same time, they're going to borrow money from the market, $333, and so on. And if you look at the relationship between dividend and investment, you can see here that this is the dividend and this is the new investment opportunity. When the company have high investment opportunity is $3,000, the dividend payment is 0. When the company is having new investment opportunity of $2,500 or $2,000 or $1,500, they're paying the dividend 0. When the new investment opportunity declines, it became just $1,000, that time they pay some dividend. Or when the new investment opportunity is $500, then they pay dividend of $666. And when the new investment opportunity is 0, they pay $1,000 back to the shareholders. So the dividend policy is also depending on the investment opportunity of the corporation. So what are the key concepts of the dividend policy? So the key concept in dividend policy is dividend sustainability. Dividends are only increased if the increase is believed to be sustainable. Special or one-off extra dividend are sometimes paid by the company to give some extra bonus to the shareholders. And the dividend reinvestment scheme, company reinvest individual dividend into fully paid shares of the company, avoid transaction cost, as the company is having a huge growth potential or having investment potential, so they would like to do the dividend reinvestment scheme. Now in this slide, it shows outstanding equity raising in 2001. You can look here that dividend reinvestment scheme is 29%, which is a huge chunk of this pie. Employee scheme, option and call is 21%. Placement is about 28%. Rights issue about 5%, and only the new float is 17%. So this is not a really common scenario for the corporation to go and issue new shares in the market, rather than they would like to borrow, rather than they would like to take the money using the dividend reinvestment scheme or the employee scheme such as option calls, or going for the rights issue or the private placement. Share repurchase. So sometimes the company can buy back its own share. It's similar to a cash dividend in that it returns cash from the firm to the shareholders, such as the dividend payment, they pay cash to the shareholders. So the share buyback is also almost the same thing. This is another argument for the dividend policy is irrelevant in absence of the taxation or other imperfection. Now, however, we need to remember that generally the companies are able to purchase about 10% of their ordinary shares in 12-month period. So when we talk about the share buyback or the share repurchase arrangement, there are several types of buyback. One is the equal access purchase. So all shareholders are invited to sell their shares to the company directly. Second, on-market purchase, purchased by a company if its own shares on the open market. Third, employee share purchase, repurchase shares from employees that were issued under the employee incentive scheme. Fourth, selective purchase, purchase of shares from specific shareholders. So this is basically a targeted shareholders. And 5 is odd lot purchase, repurchase of small parcel of shares from different scenarios or different ways. So what are the difference between the cash dividend and the share repurchase? As I mentioned earlier, the share repurchase is a way of giving cash back to the shareholders. So how does it work? So let's look at an example. Assume no taxes or the market imperfections. Consider a firm with 50,000 shares outstanding, net profit of $100,000, and the following the balance sheet. So the company's the balance sheet has about $1 million total asset or equity, which includes $100,000 cash and other asset of $900,000. So the company is currently having zero debt and all equity. Now, if you look a couple of ratios of this company, you can see that the price of the share is $20. How we get it? The company's total asset is 1 million, and the companies currently have 50,000 shares outstanding. So 1 million divided by 50,000, which is $20, which is the share price per share. Earning per share is EPS, which is earning of the company, which is $100,000, which has been mentioned earlier, divided by the number of shares, so which is 50,000. So EPS is $2. Price to earning ratio. So the price of the share is 20, earning is 2, so PE ratio is 10. So the firm is considering either paying $1 per share cash dividend or repurchasing 250,000 shares at $20 per share. So let's look what will happen. So if the company goes for the cash dividend option, and initially the company's position includes $100,000 cash, but they will pay $50,000 cash dividend to the shareholders. So the cash will reduce to 50,000. So 100,000 minus 50,000 is 50,000. Other assets will remain the same, 900,000. So the total position of the company will deduct to 950,000 from 1 million, and the company doesn't have any debt instrument in its balance sheet. It's all equity, which is $950,000. So price per share will drop to $19 because 950,000 is their balance sheet position divided by $50,000 shares. So number of shares outstanding is 50,000. So $950,000 divided by 50,000 shares outstanding. So the price per share is $19. Earning per share would be $2, the same, because the earning is $100,000. Number of shares outstanding is 50,000. So EPS is $2. The price earning ratio will drop to 9.5 from $10. So 9.5. So 19 divided by 2 is 9.5. Now this is the situation of the cash dividend. So the price per share will be $19. So it will be $1 less than the previous option. Earning per share will remain the same, $2. Price earning ratio will be 9.5. Now let's look if the company decided to give or go for the share repurchase option. If they go for the share repurchase option and they're going to buy 2,500 shares from the market at the rate of $20 per share, so the cash situation will be $50,000. Other assets will remain the same. So the total asset of the company will be $950,000. Debt is zero. Equities are 950. It's all equity. So what will be the different profitability ratio of the company? So the price per share will be remain at $20,000 because the company balance sheet is $950,000 and the company repurchased 2,500 shares. So the company initially has 50,000 shares minus 2,500 shares, which is 47,500 shares. So the company share price will be $20. EPS will be 2.105. Why? Because the company earning is $100,000. After the repurchase happens, so the number of shares outstanding will be $47,500. So EPS will be 2.105, and the price earning ratio will remain 9.5 because price is 20, earning is 2.105, so PE ratio will be 9.5. So if you compare both the situation, that when they go for the cash dividend, the share price will drop, but when they're going for the share repurchase, the share price will remain $20. Earning per share in the cash dividend option will decline to $2, whereas earning per share it will be 2.105 for the share repurchase. PE ratio it will remain the same. So you can decide which one is good for the corporation. Now this slide will talk about the share dividend and the share split. First of all, we talk about the bonus shares and share split. So the bonus share is whenever the company is paying an extra share to its shareholders. Now this is a bonus share, as it is a bonus share for the shareholders. They do not have to pay anything. So the company balance sheet it will remain the same, but the number of shares outstanding will go up. It will be the same thing for the share split, because it involves issuing new shares on the pro rata basis to the current shareholders, but it does not change the firm asset, or it does not change the firm's balance sheet structure, except it increases the number of shares outstanding, and therefore the share price will decrease. And the common explanation is to adjust the share price is to more desirable trading range. So both for the bonus share and the share split, the most common explanation is sometimes it's difficult if the share price is too high in the market, so the company might can issue bonus share on the share split. For example, think about the Berkshire, which is the company of Warren Buffett. Look at the share price of the Berkshire company owned by the Warren Buffett and check what is the current share price. And do you really think that this could be easily traded in the market for the general investors? Reverse split. The firm reduced the number of shares outstanding in the reverse split. For example, in a 1-for-3 reverse split. So each shareholder exchanged 3 old shares for a new share. So for example, if the companies currently have 3 million shares, and the price per share is very, very less in the market, and it does not really reflect a good position of the company. So the company might go for the reverse split. So in a 1-for-3 reverse split. So from the 3 million shares, the shareholder will submit 3 million shares and they will receive 1 million shares. So for example, if one particular shareholder has 3 shares in the old structure, the new structure it will receive, or he will receive, only 1 share, but the price is 3 times more from the old shares. So the reasoning for that is reduction in transaction cost, increase in share marketability or the trading range, and if the company share price is too low in the market, it doesn't have that much of respect, so it will regain some of the respect in the market. So employee share ownership plan. So throughout this lecture we talk about the dividend plan, dividend reinvestment plan. We talk about the dividend policy. We talk about the share split. We talk about the bonus share. So what is the actual dividend reinvestment plan, and why it happens? Why so many Australian company goes for the employee share ownership plan? So basically it encourages the financial participation of the employee in the company. You can see a large organization in Australia, they do have dividend reinvestment plan by the employees. Now it can involve fully paid shares, partly paid shares, specific class shares, options, shadow shares, employee share trust, tax exemptions. So these are the different ways of encouraging the employee for the share reinvestment scheme, because the company do not want to go to the market and issue the new float, because that could be expensive for the corporation. And as we've seen that only 17% out of the 100% only goes for issuing the new float in the market. So the dividend reinvestment plan or the employee participation in the employee financial participation of the company is a very important issue in Australia. Not only in Australia, any other country in the world, this is a very important factor, because the company would like to go for the retained earning to reduce its cost and increase the employee participation in the market. Hopefully you like the lecture today, and thank you very much for watching my lecture.